Let's break down some of the key things they should look for on the loan disclosure document.
Honestly, the initial documentation, the key thing is you want to look at the actual 1003. The 1003 is the actual loan application.
Okay.
And look to see if there's any errors, right? Because sometimes, even from a data entry perspective, sometimes people put their wrong social security number in, something's misspelled, things of that nature. So review the loan application thoroughly. It's only like 4 or 5 pages.
Good.
Just make sure all your pertinent information that you need for yourself is correct, right? Second thing I would say you want to pay attention to, obviously, is the loan estimate, right? Because this is showing you your interest rate and the cost. Now, please understand, in the beginning of the process, no lender controls the closing costs. Because people always say, well, this lender closing cost was cheaper than this lender. That's because you guys don't really understand the business yet. The lender only controls... the lender only... Brace yourself for an epic rant. I just heard that shit in my head. So look, lenders only control 2 things: rate and origination fees. Block A on page 2 of your loan estimate, top left corner, right? That's it. Origination fees, discount points, application, underwriting, maybe a processing fee. That stuff is only thing that the lender controls. Now, processing, application, underwriting fee, those are junk fees, right? But they're not going to get waived because lenders have to pay staff to process and underwrite. It's another way how we make money to pay our staff, right? Now, origination fees is when you're basically paying that lender to originate your loan. Now, a lot of lenders won't charge you origination fee. If you're working with a mortgage broker, they'll charge you a broker fee. The max that they can charge you is 2.75% of the loan amount. So do your math or whatever, if you want to figure out that number. And then discount points. Now, discount points is very important, especially in today's market where we have rising interest rates, right? So when you have rising interest rates like it is right now, margins are thinner for banks on the back end of loans. And this is how we really make our money, is all on the back end, pause, right? So now as rates rise, margin compression starts to happen. So now the rate that probably 6 months ago would have been no points, now it might come with a point, maybe 2 points, right?
Wow.
You're buying down your interest rate at this point. Now, if ask your lender for both scenarios, what is the interest rate with no points? What is the interest rate with 1 point? What is the interest rate with 2 points? A point is 1% of your loan amount. $100,000 loan amount, $1,000 is the point that you're going to pay to buy down. Now, if you pay a point, it doesn't mean you're dropping your interest rate by 1%. If you pay
Repeat that one more time.
If you pay a point, 1 point discount point, that does not mean you are going to drop your interest rate by 1 percentage point. Most, it would probably be a quarter to 0.375% lower. So if the rate with no points is 4%, with no points is 4%. The rate with 1 point would probably be 3.7 or 3.625. It just really depends on the lender, right? 2 point might get you to 3.5 to 3.375, depending on the lender. Now, points are not the devil, ladies and gentlemen. Yes, it is extra money that you have to pay, but our good old Uncle Sam, the IRS, the Alphabet Boys, the biggest, the biggest gangsters in the world,
really,
which is the IRS, right? They recognize discount points as prepaid interest. Right. So what that means, on your taxes, you will be able to deduct those discount points. Please speak to your CPA. This is not tax advice.
No, it's not.
This is not tax advice, but please speak to your CPA about it. But so you get some of that money back is all I'm trying to tell you. And over the long scheme of things, your payment is going to be lower. It's going to be lower interest. So it's more savings. So you just got to weigh out that pros and cons of the points and run the numbers with your loan officer to see if it makes sense for you to pay discount points. But in this market in 2022, expect to pay points in this market. It's just, it's just it's just what it is, right? But now you go through your points, you figure out if you want to lock in. I recommend locking in right now. And I normally don't lock in, me personally, till I get a contract. Till I get an appraisal, right? But in this market where interest rates are rising, we're talking about the Feds are talking about they're going to raise the Fed funds. Quantitative easing is going to start tapering. Rates are going to be in the mid fours at some point. So if you can still grab something below 4% right now, lock that baby in. Lock it in, load. If you got a 30-day closing date, lock it in for 45 days. If you got a 45 closing date, lock it in for 60 days because you need that time, because that interest rate, once it's locked in, it's only locked in for a certain period of time. And if you don't close before that rate lock expires, then you either have to do one or two things: let it expire or extend it. And if you extend it, you're going to have to pay more fees.
Absolutely.
Right? So it might cost you, a rate extension can cost you a half a point.
And what do people do? Because you know what scares a lot of my clients is, do I lock now? Do I lock later? Because when you lock, let's say you lock in today is 3.75. But then in a week, it's like now the rates are back down to 3%. Like the fear of missing out on a rate. Like, how do you calm your clients about that? Because I try to calm them down, but I'll be like, look, I could do many things, but a lender I am not. Let me get you back to your expert.
So look, let me put you on game right now. And I don't think I ever spoke about this. So that was a very good question. Okay. It's called a float down.
Okay.
Right. So you can lock in. A lot of lenders will offer this. Even I offer this, but I don't even talk about it. But but you can do a float down, right? And the float down basically states that I'm locking in at 3.75, and if the market drops, let's just say some lenders will say a quarter point, half a point, whatever it is, then you can float it down.
Ooh.
But that might cost you extra in points up front. Right. So they may charge you a half a point, 1 point to lock it in with the float down option. Now, the con in that, if they do charge a float down fee, right, then if it doesn't, then you screw. You just wasted money, basically. Whoa. And you can't get a refund. It's going to say, oh, you know what? Since we didn't float it down, can I get my 1 point back or my half a point back? No, because it's already locked. And once you're locked. You
just locked in.
You locked in. So you have to make sure, number one, you're working with a loan officer that understands the market.
Yes.
I'm not talking about real estate. I'm talking about the back end. I'm talking about secondary marketing. I'm talking about understanding
watching the rates,
mortgage-backed securities, 10-year treasuries, understanding those things and how it moves. So that way they can have it's kind of like we're at stock market, right? We talk about this on Market Mondays all the time. You got to know your charts. You got to know this information. So you need a loan officer who's that experience and has that level of education to be able to tell you, look, we can do the float down because I'm seeing X, Y, and Z patterns. These reports are coming out in the next economic reports are coming out in the next week or two. It should affect the rates this way. So if we do the float down, I think we can win. Okay. Or we don't even have to lock. I think we should wait to lock, because it's like even buying stocks, right? You know the company's going to go a little bit further. So you know what? Let me not buy at this price. Let me wait if it hits this number and I want to buy it at this price. Okay. So it's the same kind of philosophy.
They just got to watch it or get with a good mortgage servicer that's going to
who's watching the market. Because that was a lot that I just said.
I know.
You know what I'm saying?
I know.
But that option is, long story short, the option is there for you to take advantage of your rate lock, right? So just speak to your lender if they offer a float down.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.